3 of this course relates to the cash flow statements. Please pay particular attention to this module, as most students seem to struggle a lot when it comes to understanding the preparation thereof. I will go through it slowly, and try to explain as much as possible, but the onus is up to you to comprehend the concepts taught. Let's begin with the basic principles that govern the compilation of the cash flow statements. The compilation of the cash flow statement is governed by various accounting standards and regulations, depending on the jurisdiction. Here are some of the key principles and regulations that typically govern the preparation of cash flow statements. The International Financial Reporting Standards, IAS 7, Statement of Cash Flows, provides guidelines for preparing cash flow statements under IFRS. It outlines the presentation of cash flows from operating, investing, and financing activities and requires companies to report cash flows in a standardized manner. So, basically, the objective of IAS 7 is to require the presentation of information about the historical changes in cash and cash equivalents of an entity by means of a statement of cash flows, which classifies cash flows during the period according to operating, investing, and financing activities. You can look up further on this standard. Looking at the Generally Accepted Accounting Principles or GAAP. In the United States, the Financial Accounting Standards Board, FASB, issues standards for cash flow statement preparation. Generally, it follows similar principles to IFRS. Moving on to the direct versus indirect method. Both IFRS and GAAP allow for either the direct method or the indirect method for presenting operating cash flows. The direct method shows actual cash receipts and payments, while the indirect method reconciles net income to net cash provided by operating activities. While both are ways of calculating your net cash flow from operating activities, the main distinction is the starting point and types of calculations each uses. The indirect method begins with your net income. Alternatively, the direct method begins with the cash amounts received and paid out by your business. Looking at operating, investing, and financing activities. Cash flows must be categorized into operating activities, investing activities, and financing activities. Operating activities include cash flows from the primary business operations. Cash flow from operating activities, or CFO, indicates the amount of money a company brings in from its ongoing, regular business activities, such as manufacturing and selling goods or providing a service to customers. It is the first section depicted on a company's cash flow statement. Investing activities involve cash flows related to the acquisition and disposal of long-term assets and investments. Cash flow from investing activities is a section of the cash flow statement that shows the cash generated or spent relating to investment activities. Investing activities include purchases of physical assets, investments in securities, or the sale of securities or assets. Financing activities, on the other hand, include cash flows from borrowing, issuing stock, and dividends. Financing activities are transactions between a business and its lenders and owners to acquire or return resources. In other words, financing activities fund the company, repay lenders, and provide owners with a return on investment. Financing activities include issuing and repurchasing equity. Stop the lesson for a moment and read that again. This is the core idea of the cash flow statement, so understanding its concept is vital. We now come to consistency and comparability. The cash flow statement should be prepared consistently from period to period to ensure comparability. Changes in accounting policies or methods should be disclosed in the financial statements. The ultimate goal of any set of accounting principles is to ensure that a company's financial statements are complete, consistent, and comparable. This makes it easier for investors to analyze and extract useful information from the company's financial statements, including trend data over a period of time. Moving on to disclosure requirements. There are often specific disclosure requirements regarding significant non-cash transactions, such as the acquisition of assets through assumption of liabilities or the issuance of stock for the acquisition of another company. Generally, public companies are required to disclose only information that can have a material impact on the financial results of the company. The most common items that the companies must report include the following: audited financial statements. Employed accounting policies and changes in the accounting policies. Materiality is a fundamental concept in accounting that requires focusing on information that could influence the economic decisions of users. Material cash flows should be accurately reported, while immaterial items may be aggregated or omitted. Just to further explain that, the materiality principle is an accounting practice that encourages you to record only the financial information that significantly impacts your business decisions. By adhering to this principle, you can keep your financial records concise and meaningful, avoiding the clutter of insignificant details. Finally, we come to internal controls and audit requirements. Companies are often required to have adequate internal controls over financial reporting to ensure the accuracy and reliability of their cash flow statements. Additionally, external audits may be required to verify the accuracy of financial statements, including the cash flow statement. So, internal control is a process, effected by an entity's board of directors, management, and other personnel, designed to provide reasonable assurance that information is reliable, accurate, and timely. Of compliance with applicable laws, regulations, contracts, policies, and procedures. Adherence to these principles and regulations ensures that cash flow statements provide users with reliable information about a company's liquidity and cash flow management. Again, stop the lesson and revise the concepts discussed. Your understanding of these concepts will ensure that you have a solid base to start compiling the cash flow statements with ease. In layman's terms, what is the definition of the cash flow statement? A cash flow statement is a financial statement that summarizes a business's cash inflows and outflows over a period of time. A good question to ask is, why do we need a cash flow statement? This question will be answered as we go along. Its importance will be revealed. In accounting, there are two main methods for preparing your books. The first method is the cash method, and the second method is the accrual method. Starting with the cash method, you recognize your revenue when cash is received, and you record your expenses when cash is paid out. With the accrual method, you recognize revenue as it's earned and record your expenses as they are incurred. Take note of the two methods. So, what does that mean? If you're cash accounting, then technically you only have one financial statement, and that is the income statement. See the illustration. It summarizes your revenues and expenses over a period of time, leaving you with a profit or a loss. But, with the cash method, you recognize revenue when cash is received, and you record expenses when cash is paid out. That leaves you with a net cash inflow or an outflow. An important note is that the income statement prepared under the cash method is equivalent to a cash flow statement. A lot of small businesses do their books this way, which is acceptable, but the cash method isn't allowed under IFRS or GAAP. Interesting, right? You must use the accrual method, so revenue must be recognized as it's earned and expenses must be recorded as they are incurred. That means no physical money is paid or received as the transaction happen. In accrual accounting we still have the income statement, but this time it represents what a business has earned and incurred, so it's not equivalent to a cash flow statement. Again, it's not equivalent to the cash flow statement. Look at the illustration for clarity. Businesses using the accrual method keep a separate cash flow statement alongside their income statement. They also keep a balance sheet which holds their assets, liabilities, and equity. What is a cash flow statement, you ask? It summarizes a business's cash inflows and outflows over a period of time. So, what does it look like? Totally different from the income statement, I can assure you. We begin with the opening cash amount at the start of the period and compare it against the closing cash amount at the end of the period. Just as the illustration suggests. We can find both these numbers in the balance sheet. We take last year's closing balance, which is actually this year's opening balance, and subtract the figure from this year's closing balance. The movement between the two is the net increase or decrease in cash. Once we know that, then we can get on to the real purpose of the cash flow statement. There are three main sections. The cash flow from operating activities, the cash flow from investing activities, and lastly, the cash flow from financing activities. Operating activities are the main revenue-generating activities of the business. These are the cash flows involved in selling goods or services. Did you get that? It's the figures from the main revenue-generating activities of the business. Stop and ponder. Next, we have the investing activities. These sit outside of the business's core operations. They involve the buying or selling of investments or other long-term assets. Write that down. It involves the buying or selling of investments or other long-term assets. Investing activities. Lastly, we have the financing activities. These relate to the funding of the business through raising or repaying cash to third parties, banks, or the owners of the business. Again, stop the lesson and revise the three concepts. Now we're going to look at the basic structure of the cash flow statement. Positive numbers represent cash inflows, and negative numbers are cash outflows. Remember, there are two ways to make a detailed cash flow statement. There is the direct method and the indirect method. Let's start with the direct method cash flow, looking specifically at the section, from operating activities. The direct method mirrors the income statement, prepared under the cash method which was discussed earlier. At the top we have cash receipts from customers, below that, we have cash paid to suppliers, followed by cash paid to employees. Remember, we are taking these figures directly from the income statement. Interest paid and taxes paid come from the indirect, non-operating costs of the income statement. We are only looking at the top section of the cash flow statement, cash flows from operating activities. Look at the illustration and see the layout of this section. It mirrors the income statement. The direct method of the cash flow statement is as follows. Cash receipts from customers, which mirrors revenue. Cash paid out to suppliers and employees, and interest and taxes paid. Collectively, these mirror the business's expenses. The section below that is the cash flow from investing activities. These include cash outflows from buying investments or other long-term assets, and cash inflows that come with selling them. So, everything in this section relates to the buying and selling of assets or investments. The section below that is the cash flow from financing activities. These relates to the raising or repaying of cash or capital. Still on the last section. There are two ways a business can raise or repay cash or capital. First, they can borrow money from a third party or bank which would increase their liabilities, and second, a business can look to its owners or shareholders who can make capital contributions, which increase equity. On the flip side, they also make loan repayments back to the bank or distribute dividends back to the owners, so when we add up the net cash flows from operating, investing and financing activities we can reconcile the net increase or decrease in cash. I would now highly recommend that you stop the lesson and go through this section again. You will understand it better the second time around. The direct cash flow method uses real cash inflows and outflows taken directly from company operations. This means it measures cash as it's received or paid, rather than using the accrual accounting method. Accrual accounting recognizes revenue as it's earned, rather than when you receive payment. Conversely, the cash flow direct method measures only the cash that's been received, which is typically from customers, and the cash payments or outflows, such as to suppliers. The inflows and outflows are netted to arrive at the cash flow. The direct method is also known as the income statement method. Let's take a look at the indirect method of the cash flow statement. Carefully examine this method. Steps are listed so that you can see the difference between the direct method and the indirect method. So, let's get to it. In step 1, the indirect method always begins with the net profit or loss from the income statement. That means that we only take the last line of the income statement, which is the net profit or loss, and place that figure here. That should be pretty easy. Next, we have step 2. This step needs a bit of searching and identification on the income statement. We are looking for depreciation and amortization on the income statement, and we are also looking for an entry on the income statement that relates to profit or loss of an asset. Sometimes it's there, sometimes not. Remember, We said that this section deals with the buying or selling of investments or other long-term assets. So, after scrutinizing the income statement, we find depreciation and amortization, and any profit or loss on the sale of non-current or long-term assets. Again, I would suggest that you carefully relook at what was discussed for Step 2. It gets easier if we take our time in finding what we should be looking for. Moving on to Step 3, we adjust for the movement in working capital. Working capital is the difference between current assets and current liabilities. At first, this would seem like a complex mathematical equation that needs precise measurements to build a futuristic rocket engine, and it is. So, let's all go home and cry our eyes out, because we will never find it. But, for the brave souls that don't give up without a fight, let's drag on. Stop what you're doing, and look at the balance sheet that we worked on earlier, the Omatla Training Academy Comparative Balance Sheet. Look at the current assets section and the entries clumped together. Accounts receivable, other receivables and prepaid expenses. On a side note, prepaid expenses are an asset because it represents a future economic benefit that the company has already paid for. Add these figures up in the different reporting years, then subtract the one from the other. That's 14,050 rands less 8,850 rands, the net result is 5,200 rands. Which is actually a decrease in receivables. Do the exact same for the items in the current liabilities section. Now, further on in the cash flow example we will be looking at this complex mathematical equation that needs precise measurements to build a futuristic rocket engine, again. Please take note. Increases in current assets like inventory or receivables reduce cash flow, whereas increases in current liabilities like payables increase cash flow. All of these numbers are found on the comparative balance sheet. You're probably thinking that the direct method sounds a lot easier, so why don't we just use that? You're right, it is easier to read but it's actually harder for accountants to prepare, so we don't use it as much as the indirect method. We can find a lot of these numbers in the income statement and the balance sheet. Let's start preparing our indirect cash flow statement from the information at our disposal. Firstly, we start with an income statement. Look at the one called Omatla Training. The income statement summarizes Omatla's revenues and expenses for the year. Carefully scrutinize the figures shown. Let's begin. What are we reconciling? Cash. This is a cash flow statement after all, so let's start with Omatla's comparative balance sheet. As we can see, they held 13,895 rands in cash at the end of last year, which is this year's opening balance, and this number increased to 17,000 rands in this financial year. At the end of this year we can lift these numbers and place them at the bottom of our indirect cash flow statement. Overall that's a net increase in cash of 3,105 rands. But how did Omatla pull this off? We need our cash flow to balance back to this figure. Turning our attention to the very top of the cash flow statement. Cash flow from operating activities. Going through our steps, we find, in Step 1, Omatla's net profit or loss for the current year on the income statement. On the bottom of the income statement we can see that Omatla earned 9,650 rands this year from their core operations, so we'll take Omatla's net profit and put it right at the top of cash flow from operating activities. Moving on to Step 2. If we have a detailed look at our key facts page, we said that they sold some furniture for 10 rands. So, let's quickly do some workings. The furniture originally cost Omatla 20 rands. By the time it was sold it had incurred 5 rands in depreciation, leaving it with a carrying value of 15 rands. Omatla sold this furniture for 10 rands, which left them with a loss on the sale of 5 rands. This is also a non-cash expense and it was charged to general and admin expenses in the income statement. We need to reverse it out in our cash flow statement, so we'll add back a loss on the sale of furniture of 5 rands. Still on Step 2 we need to reverse out all of the non-cash expenses that appear above the bottom line in the income statement. These are depreciation and amortization. These represent the gradual process of writing off long-term assets. So, this year Omatla incurred 850 rands in depreciation and amortization, so we'll add this back in our cash flow from operating activities, But that's not all. Omatla made a loss on the sale of long-term assets. This is also a non-cash expense, and it was charged to general and admin expenses in the income statement. We need to reverse it out in our cash flow statement, so we'll add back a loss on the sale of furniture of 5 rands. Before we proceed to step 3, relook at our calculations for step 2 and ponder on them. It's really not rocket science. In step 3 we need to adjust for the movement in Omatla's working capital. Working capital is the difference between current assets and current liabilities, ignoring cash or bank. Current assets are typically made up of inventory and receivables, while current liabilities are payables. So, going back to our rocket science project, we can find the movement in all of these on Omatla's comparative balance sheet. It doesn't look like Omatla has any inventory, but they do have receivables. Accounts receivable, other receivables and prepaid expenses. We will again do the calculations, all of which add up to 14,050 rands, see the balance sheet, in the current year and 8,850 rands last year. Subtract one from the other. That's an increase in receivables of 5,200 rands during the year, so remember, an increase in receivables reduces cash flow, so we subtract 5,200 rands from cash flow from operating activities. We like to think of it this way. If receivables have gone up, then Omatla is owed more money, which isn't good for cash flow. I need you to stop the lesson, carefully contemplate what we discussed this far, look for the figures on the illustrations provided. Understand how we derive to the figures shown. Moving on, payables work in a similar way. Omatla has accounts payable, taxes payable, accrued expenses and some deferred revenue. All of this adds up to 14,400 rands in payables in the current year, and last year they had 14,850 rands in payables. Subtract the one from the other. That's a year-on-year decrease in payables of 450 rands. We subtract decreases in payables under cash flow from operating activities because if payables go down then more supplier accounts have been settled, so there's less cash owed. When we take Omatla's profit and add back their non-cash expenses and adjust for the movement in working capital, then we can see that they had a net cash inflow of 4,855 rands from operating activities. Back to our key facts page. We can see that Omatla spent 910 rands on computer equipment. This is a cash outflow from investing activities because they bought long-term assets, but Omatla also sold a long-term asset. Remember that furniture we talked about? Omatla made a loss on its sale, which we called a non-cash expense. We added it back in cash flow from operating activities, but we also need to record the cash receipt on the sale of 10 rands. This sale isn't part of Omatla's core business, so we record it as a cash flow from investing activities. A few more things we need to do here to finish this off. Cash flow from investing activities. Now we have cash flow from investing activities. We're done with operating activities, so the rest of the cash flow statement is the same whether you're using the direct or the indirect method. When we total it against the purchase of computer equipment, that leaves us with a net cash flow from investing activities of 900 rands. This time it's a cash outflow, so the number's negative. Once again, on the key facts page we can see that Omatla raised 100 rands in long-term debt. This is a liability to a third-party bank, and this year they made no debt repayments. They issued 50 rands in common stock, which is a capital contribution from the shareholders, who own the business, which increases equity, and they paid 1,000 rands out in dividends back to these shareholders. That would have decreased their equity. We can pull all these numbers through into cash flow from financing activities. Omatla received 100 rands in cash from long-term debt, they raised another 50 rands in equity, and they paid out 1,000 rands in dividends, so that's a net cash outflow from financing activities of 850 rands. Stop the lesson here and review everything discussed. You have to have a notepad on hand and draft out the cash flow statement as per the illustrations to get a better understanding of the concepts taught.